I want you to picture a line on a graph for a moment. Just visualize it in your head.
Yeah.
It starts in the bottom left corner, and it just shoots up and to the right. A nearly perfect 45-degree angle. It doesn't really waver. It doesn't dip for a recession. It doesn't flatline during a pandemic. It just goes up.
Right. The dream chart. The chart every single VC promises in their pitch deck, but you never, ever actually see it in the wild.
Exactly. Usually in the real world, physics applies. We have the law of large numbers. You get big, you get heavy, you slow down.
Yeah.
It's just inevitable.
Or you hit a ceiling. You saturate your market. There's nowhere else to grow.
Right. But I want to start today with a number that, frankly, shouldn't exist. 27.
27.
27 consecutive quarters of year-over-year revenue growth exceeding 30%. That's nearly 7 years of hypergrowth, uninterrupted.
And we have to contextualize that timeline, That isn't 7 years of smooth sailing for the global economy.
Not at all.
That period covers a global pandemic, historic global inflation, massive currency devaluations in their core markets, and aggressive invasions by the biggest tech companies on the planet.
It just sounds impossible. Usually when I see a chart like that, I assume it's some tiny startup going from like 1 million to 2 million in revenue. It's easy to grow 30% when you're small.
Precisely. But this company is doing it while generating over $20 billion a year. They are defying gravity at a massive scale.
The company, of course, is MercadoLibre, ticker symbol MELI. Now, if you read the headlines, people love to call it the Amazon of Latin America. It's catchy, fits in a tweet. But as we're going to find out today, that nickname is actually incredibly lazy.
Oh, it is. It's a massive oversimplification that actually hurts your ability to understand the business. If you really want to get what this beast is, you have to imagine if Amazon, PayPal, and a major logistics carrier like, say, UPS or FedEx were all born as triplets, grew up in the same house, and just never moved out. That's MercadoLibre.
I love that image. The triplets that never separated. But here's the twist for today's deep dive. We are not just going to sit here and cheerlead this growth streak. Because, frankly, trees don't grow to the sky forever.
No, they don't. And the market has priced this company for absolute perfection.
So we have a stack of sources in front of us, and we're centering on a skeptical buy-side investment report. And I want to really emphasize that word, skeptical.
Right. The mission of this deep dive isn't to hype the stock. The mission is to stress test it. The premise of this report is essentially, this company is not investable until proven otherwise. We need to look for the cracks in the armor.
Because the stakes are incredibly high right now. We're talking about a company that has grown revenue 5 times over in just 5 years, from what, $4 billion to nearly $21 billion.
It's an incredible run.
But now you have the founder stepping down after 26 years. You have competitors like Shopee and Amazon circling. So the core question we need to answer today is pretty simple. Is the best growth already over?
That is the $96 billion question, isn't it? That's the current market cap. If you're a new listener or a new investor looking at this today, you have to ask, am I buying at the tot? Is this the peak of the mountain? Or is this just the end of the beginning?
So to figure that out, we're going to break this down into a few distinct chapters. We need to look at the ecosystem they built, what we'll call the Moat. We have to look at their history, how they actually won the ground game. We need to put them through what I'm calling the stress tests, how they handle a crisis. And then we've got to look at the money, the financials, the valuation.
It's a full audit, from the warehouse floor all the way to the balance sheet.
Let's unpack this. Section 1 of our deep dive is the executive overview, but really it's about the Moat. I said it's not just Amazon. So for the person who has never bought anything in Brazil or Argentina, what is this thing, actually?
To really get the Moat and to understand why that Amazon comparison just fails, you have to completely forget how commerce works in the United States or Europe.
Okay, wiping my memory.
Go. In the U.S., if Amazon disappeared tomorrow, poof, just gone, you could still buy things online. You'd go to Walmart.com or Target. You'd pay with your Visa or MasterCard, which works everywhere. And the package would be delivered by UPS or FedEx or the Postal Service, which are, they're reliable public utilities.
Right.
The rails exist independently of the store.
The infrastructure is just there for anyone to use.
Yeah.
Amazon just built a better store on top of existing roads.
Exactly. In Latin America, historically, that infrastructure did not exist. Or if it did, it was broken. So MercadoLibre couldn't just build the store. They had to build the roads, they had to build the banks, and they had to build the post office.
Let's make this concrete. Walk us through a day in the life.
Sure. Let's trace a transaction to see the whole ecosystem in action. Imagine you are a merchant in a medium-sized town in Brazil. You make handmade leather shoes.
Okay, I'm a shoemaker. I've got great shoes. It's 10 years ago. How do I sell these? You largely don't, not beyond your town anyway. You sell to your neighbors for cash. Maybe you have a little shop, but you are geographically locked. You don't have a credit card terminal because the big oligopoly banks in Brazil charge these exorbitant fees and won't touch a small business like yours. And you can't ship them to Sao Paulo because the National Postal Service might lose the package, or it'll take 3 weeks and cost more than the shoes themselves.
So I have supply, but I have zero distribution. I'm completely stuck.
Enter the MercadoLibre ecosystem. First, you list the shoes on their marketplace. That's pillar 1, commerce.
Simple enough.
But then a customer in Sao Paulo wants to buy them. Here's the problem. That customer might not even have a bank account. A huge chunk of the population in Latin America is unbanked or underbanked.
So the deal just dies right there.
It used to. But now that customer uses Mercado Pago. This is the second pillar, Fintech. They might go to a local convenience store, deposit cash into their digital wallet, or maybe even use a small credit line provided by MercadoLibre itself. They pay you instantly. Okay, so Fintech solved the friction of how do I get paid?
Right. But now, how do you get the shoes to Sao Paulo? You don't go to the post office. You drop the package off at a corner store, maybe it's a dry cleaner or a pharmacy. That is part of the Mercado Envios network.
Ah, the agencias.
Yes, that's pillar 3, logistics. A yellow MercadoLibre truck picks it up, takes it to a massive fulfillment center that MercadoLibre built, sorts it with their software, and delivers it to the customer, often in less than 24 hours.
I see the picture now. They didn't just find a buyer. They acted as the bank, the truck, and the insurance policy for the whole transaction.
And that is what creates the stickiness. This is the moat. If you're that merchant, you can't just leave MercadoLibre and go to a competitor easily, because if you leave, you don't just lose the website traffic.
No.
You lose your payment processor. You lose your shipping department. You lose your credit rating.
You're kind of naked without them.
Essentially, and the stats totally back this up. In 2023, they moved, what, $44.7 billion in gross merchandise volume GMV.
Huge number.
But the key stat is that essentially all of that GMV now flows through their own payment rails and their own delivery rails. They capture value at every single step of the chain.
So they get a cut when I sell a shoe. They get a cut when the customer pays for it, and they get a cut for shipping it.
Correct. And increasingly, they get a cut because you paid them to advertise the shoe on the site in the first place. That's the advertising pillar, which is growing incredibly fast.
It sounds impenetrable. Honestly, when you describe it like that, owning the rails, the bank, and the store, it sounds like a monopoly.
Okay.
So playing the devil's advocate, which is our job today, why this skepticism? Where's the risk in this?
Well, the report highlights 3 massive risks that we just can't ignore. Just because you built a castle doesn't mean you can't be besieged.
Okay, so who's at the gate?
First is the competition. We mentioned the Amazon of LATAM nickname, but the real Amazon is actually there.
Right.
They are in Brazil, they have incredibly deep pockets, and they are patient. They've been ramping up their logistics network significantly.
And Amazon famously does not mind losing money for a decade to win a market.
Never. Then you have the Asian competitors, Shopee and Shein. They're rising very, very aggressively in the region. Shopee, in particular, is a discounter. They come in and just burn cash to steal market share.
We'll get into the mechanics of that war later because it's fascinating.
Yeah.
What's the second big risk?
Macro volatility. I mean, we are talking about Argentina and Brazil. These are their 2 biggest markets. These are economies famous for inflation, for currency crashes, for political instability. Operating there is not like operating in Iowa.
Right. You wake up one morning, the government has changed, and the currency is devalued by 50%. And that's just a Tuesday in Argentina.
Sadly, yes. And it completely destroys your earnings in U.S. dollars.
And the third risk?
The leadership change. Marcos Galperin, the founder, has been the CEO for 26 years. He is the Bezos of this operation. He is the visionary, and he is stepping down. Whenever a visionary founder leaves the cockpit, you have to worry about whether the culture can actually survive.
So for our listener, the learner takeaway here is that we are looking at a wide moat business, absolutely. It's a true ecosystem, but it is facing specific high-stakes external threats that would absolutely terrify a normal CEO.
Correct. And to understand if they can survive those threats, we have to look at how they got here in the first place. Which brings us to their historical execution.
Let's get into that. Section 2, how they won. Because as you said, they didn't start with a bank and a fleet of airplanes. They started in a garage in Buenos Aires in 1999.
They did. And the report makes a really important distinction here about their evolution. In the early days, they were basically just an eBay clone. It was an auction site.
I remember that era. Used goods, bidding wars, the whole thing.
Exactly. But they realized very quickly that the eBay model has a ceiling in Latin America because of that lack of trust and infrastructure we just talked about.
Mm-hmm.
If I buy a used camera from some stranger in another city and I send him cash, am I ever going to get that camera? Probably not.
The trust gap.
That's the whole problem. So Galperin and his team realized they had to solve the friction. They pivoted from just connecting people to guaranteeing the transaction. And this drove user growth from about 50 million users in 2019 to 218 million active users in 2023.
Whoa. That is nearly a 5x increase in the user base in just 4 years. That's staggering.
And it wasn't an accident. It was about using logistics as a weapon. You mentioned the 1.38 billion items they shipped in 2023, but the insight here is that 95% plus of all items sold on the platform go through Mercado Envios.
Why is that penetration so high? Why doesn't anyone just use the regular post office anymore?
Because MercadoLibre created a standard of delivery that built massive amounts of trust. In a region where mail was historically unreliable, packages getting lost, taking weeks to arrive, MELI started offering 48-hour delivery, then 24-hour, then same day.
So they didn't just sell speed, they sold certainty. If I click buy, it will actually show up at my door.
Exactly. And once they had that trust, they turned on the monetization machine. They didn't just grow users, they figured out how to make more and more money from each one. We look at the take rate. That's the percentage of every sale they keep. It has steadily risen to the 16 to 18% range.
Okay, and that's pretty comparable to Amazon's third-party seller fees.
It is, but then you layer on the Fintech expansion. Fintech is now about 43% of their total revenue.
Wait, hold on. Almost half their revenue is from the financial side.
Yes, so when you ask, what is this company, it's almost half a bank. They make money when you buy the product, and they make money on the transaction itself.
So they've just executed flawlessly on this pivot. They went from eBay to Amazon plus PayPal.
The report gives them an A+ for history. You just cannot argue with the execution. But as every investment disclaimer says, past performance does not guarantee future results.
Right.
The real test is, how do they handle a crisis? Because it's easy to look like a genius in a bull market.
And that leads us perfectly into Section 3. The report calls these strategic inflection points. I call them stress tests. These are the moments where the company could have died or stalled, but didn't.
This is my favorite part of the analysis because it really reveals the DNA of the management team. Anyone can lead when the waters are calm. You learn who the captain is when the storm hits.
So let's look at test number 1, the Amazon threat in 2016.
Okay, so set the scene. It's 2016. Amazon announces they are opening distribution centers in Brazil. The market panicked, the stock tanked. Everyone thought, okay, game over. The 800-pound gorilla is here. They are going to crush the local player.
I remember that narrative. It's what happened to retailers in the U.S. Amazon arrives, you die. End of story.
Right. But what did MELI do? A weaker management team might have tried to sell the company, or maybe retreated to a niche. MELI. They didn't retreat, they doubled down.
What was the counter move?
They pivoted heavily into what's called managed fulfillment. Before this, they were mostly just helping with shipping labels and things like that. After the Amazon threat, they started building these massive warehouses. They basically said, if you want a war on logistics, we will give you one. And they subsidized shipping heavily.
So they burned cash to build the moat even wider.
They did, and the result, MELI maintained a roughly 20% compound annual growth rate during that period. And today, their delivery network in Latin America is actually denser and faster than Amazon's in many key regions. They won the ground game because they knew the terrain better.
That's incredible. They beat the logistics king at logistics. Okay, test number 2. The pandemic, 2020. Now, obviously, this was a huge boom for e-commerce, but operationally, it must have been an absolute nightmare.
It was a massive stress test. Demand just spiked overnight. Everyone was locked down. If your logistics network breaks at that moment, you lose that trust you built forever.
You're done.
You're done. The report highlights that instead of crashing, they hired 5,000 logistics staff almost instantly.
5,000 people in the middle of a global lockdown.
In a very, very short window. They prioritized operational continuity above all else. They spent whatever it took to keep the packages moving. And the outcome was that 2020 sales went up 85% year over year in US dollars.
They captured the market.
And importantly, they kept those new habits sticky. Once people realized they could buy groceries and essentials online, and that MELI would actually deliver them during a plague, they didn't stop.
Okay, so they survived the gorilla, they survived the plague.
Yeah.
Let's talk about test number 3, the Shopee price war, 2021-2022. This one is fascinating because it's not about logistics, it's purely about price.
Right. Shopee is owned by Sea Limited, a Singapore-based giant, and their playbook is aggressive. It's the cash burn strategy. They entered Brazil and basically said, we will lose money on every single order just to buy your loyalty.
The classic disruption model. How aggressive are we talking?
Extremely. They offered free shipping on almost everything. You could buy a $2 pen and they would ship it to you for free.
Which is just economically insane. The shipping costs more than the pen.
It creates a terrible, terrible unit economic profile. They're just bleeding money. But the goal is addiction, right? Get the user on the app.
Right.
So MELI had a crisis meeting. Do they ignore it? If they ignore it, they lose traffic. Do they match it? If they match it, their profit margins, which they spent 20 years building, just evaporate.
It's the classic incumbent's dilemma. So what was the counter move? You mentioned they lowered the free shipping threshold.
They lowered it from 79 reals down to 19 reals. It was a massive drop. It cut right into their profit margin.
But here's the genius part, right? They didn't do it on everything.
Exactly. This is where they leveraged their logistics advantage. Because MELI owns the warehouses and the trucks, their cost to serve per package was fundamentally lower than Shopee's. Shopee was relying heavily on the Brazilian postal service and third-party couriers, so they were paying full retail rates for shipping.
Ah, I see. So MELI was throwing that $2 pen onto a truck they already owned, which was already going to that neighborhood anyway. The marginal cost was super low.
Yeah.
Shopee was paying a courier, what, $5 to deliver a $2 pen?
Correct. So MELI could bleed longer than Shopee could. It was a war of attrition. And MELI had the deeper lungs. By late 2022, Shopee realized they were burning hundreds of millions of dollars with no path to profitability. They blinked, they raised their shipping prices, and the users flocked right back to MELI.
And the current score?
MELI has about a 35% market share in Brazil versus Shopee's 17%. They won.
It seems like there's a pattern here. When they're threatened, they don't just turtle up, they get aggressive.
They are anti-fragile, to borrow a term. Stress makes them stronger because they use it to gain share against weaker rivals who can't afford to fight back.
Which brings us to the most recent test. Test number 4, the credit crunch of 2023. This isn't about packages, it's about money.
This is the financial stress test. Interest rates skyrocketed globally, and especially in Brazil, inflation was high. If you're a bank, which we've established they basically are, this is a dangerous time. When rates go up and inflation bites, people stop paying back their loans.
Right. And we saw provisions for losses jump pretty dramatically, didn't we?
We did. In late 2022, their provisions for loan losses jumped 83%. That is a scary number. It means they were expecting a massive wave of defaults was coming.
So how did they handle it? Did they shut down the lending arm?
No, they recalibrated. They just tightened the screws. They slowed down credit origination to riskier borrowers. They improved their underwriting models, using all that data they have from the marketplace to predict who would pay. And uniquely, in Argentina, due to some new regulations, they actually stopped earning interest on certain customer funds, but still managed to keep the core business profitable.
So the nuance here is that they just priced the risk better.
Exactly. They knew some loans would go bad, so they charged high enough interest rates to cover it. And we will get into the specific numbers on that in the financial section because it's absolutely hair-raising.
So the inference from these 4 tests is that this company doesn't just survive stress. It seems to have this institutional ability to navigate it and come out stronger.
Yes. But, and here's where we get to the skeptical part, that credit risk hasn't gone away. The bomb was diffused, but it's still sitting in the room.
Right. And that transitions us perfectly to Section 4. Financial stability. We've talked about the growth, the logistics, the wars. But are they actually making money? Because for a long time, the knock on MELI was growth at all costs.
That was true for years, and Wall Street punished them for it. But the turn has happened. We've seen a massive shift from growth to profit. The report notes that their operating margin went from roughly 0% in 2018, basically breaking even, to about 12.6% in 2023. Operating income hit $1.8 billion.
That is a serious cash machine.
It is. And their return on invested capital, ROIC, is in the 30 to 40% range. For listeners who don't follow that metric, that is exceptionally high. It means for every dollar they put back into the business, they are getting a massive return. It signals immense value creation.
However, I hear a but coming. There's always a but.
There is always a but. We have to talk about the bear case. And it centers on that credit portfolio we just mentioned.
Lay it on me. What's the scary number?
The scary number is the 90-day non-performing loan ratio, NPL. Basically, the percentage of loans that are seriously overdue. For MercadoLibre, that number is around 20%.
Whoa, stop. Hang on. Did you say 20%? 1 in 5 of their loans isn't being paid back on time.
Roughly, yes.
In the U.S. banking world, if a bank had 20% of its loans going bad, the FDIC would shut them down by Friday afternoon.
Absolutely. A normal bank panics at 2 or 3%.
So is MELI just reckless? Are they just handing out money to anyone with a pulse?
It looks reckless if you view them as a traditional bank. But you have to think of them more like a credit card company for the subprime market. They're lending to people who have no credit history. The risk is baked right into the cake.
Okay, so how do they not go bankrupt with a 20% default rate? The math seems impossible.
It's all about the spread, the net interest margin, or NIM. If I lend you $100 and there's a 20% chance you don't pay me back, I need to charge you enough interest to cover that risk. MELI charges annual interest rates that can exceed 100% in some cases.
Wow. So for every 5 people they lend to, 1 defaults, but the massive interest payments from the other 4 cover the loss and still generate a huge profit.
Precisely. That's the math. Their net interest margin is about 30 to 40% on some of these products, whereas a company like Nubank, their main fintech peer, is around 10 to 15%. So the math works, as long as the economy is okay.
And there's the rub.
The expert warning in the report is stark on this point. This model works now. But if Brazil hits a massive recession, a real depression where unemployment spikes, that 20% default rate could spike to 30 or 40%. At that point, the high interest rates don't matter anymore because nobody is paying. It could wipe out their profits very, very quickly.
It's a ticking time bomb if the macro environment really goes south. It's high risk, high reward. And speaking of macro, let's talk about the silent killer, currency risk.
This is the constant headache of investing in Latin America. MELI reports its earnings in US dollars. Wall Street wants to see dollars, but they earn their money in Argentine pesos and Brazilian reals.
And those currencies tend to, well, they go down relative to the dollar.
Consistently. In 2023 alone, foreign exchange losses wiped out $117 million of net income. Poof, just gone.
It's painful.
It is. The skeptics' view is that you always have to mentally haircut their future revenue. If they say they'll grow 30%, you should probably see maybe 20% in dollar terms because the currency is going to eat the rest. You are fighting a headwind constantly.
But despite the bad loans and the currency drag, they are sitting on a pile of cash, right? They're not in danger of going under.
No, they are. And this is a safety net. They have over $3.3 billion in cash, and they are generating positive free cash flow, about $1.57 billion in 2022. This is crucial because it means they are self-funding. They don't need to go to Wall Street and beg for money if things get tight. They control their own destiny.
That is a huge shift from the startup days. Okay, let's move on to Section 5, Management and Capital Allocation. We touched on this in the intro, the end of an era.
Marcos Gelperin, he's not just the founder, he's the soul of the company. And he is stepping back to executive chairman in 2026. The new CEO will be Ariel Surfstein.
Now, usually when a legendary founder leaves, the stock drops. People get nervous. Think about Starbucks when Schultz leaves, or Disney without Iger. What happened here?
The stock hit all-time highs on the news.
Really? Why? That feels counterintuitive.
Because Ariel isn't some outsider. He's the current Commerce president. He's a Stanford MBA. But more importantly, he has been in the trenches with Galperin for years. He's the one who ran the marketplace during the Shopee War. Investors see this as a natural progression, not a crisis.
So it signals that the institution is mature enough to survive without the founder holding the wheel every single day.
Exactly. And speaking of maturity, let's look at their capital allocation scorecard. Morningstar rates them as exemplary. Why do they get such high marks?
Yeah, what does that mean in practice?
Discipline. Think about the temptation when you have billions in cash and you are the king of LATAM. You want to go buy things. You want to make these splashy acquisitions. Let's buy a bank in Mexico. Let's buy a big retailer in Chile.
The empire-building phase.
Right, and MELI just doesn't do that. They avoid the shiny object syndrome. Look at how they handled payments. Instead of buying a huge, clunky bank to learn how to do it, they sold a $750 million stake to PayPal back in 2019.
So they brought PayPal in as a partner.
Exactly. They took PayPal's money and their expertise. They learned from the best rather than trying to buy the best. That is just smart capital allocation. And primarily, they reinvest in themselves. They poured money into logistics when Wall Street was screaming for profits. And now, that logistics network is the moat that keeps Amazon at bay.
And now, a sign of maturity that really surprised me. Dividends.
Yes. They initiated their first ever dividend plan payable in 2027.
Okay. Is this good or is this bad? Some people say dividends mean a tech company is out of ideas. We can't grow anymore, so here's your money back.
That's the cynical view, for sure. And for a company like, say, Google or Meta, maybe that's true. But in this case, the expert interpretation is that it signals confidence. It says, we have enough cash to fund all our growth initiatives and pay you back. It marks a shift from a hyper-growth startup to a compounder. They are becoming a blue chip.
A Latin American blue chip. I like the sound of that. All right, let's get to the bottom line here. Section 6. Valuation and the final verdict. What's the price tag for all this excellence?
Well, it's not cheap. The stock is trading around $1,900 per share. The market cap is $96 billion. In terms of multiples, it's growing at about 37 times its 2025 estimated earnings.
37 times earnings. The S&P 500 average is, what, around 20? So it's almost double the market average. That seems steep.
It is a premium. You're paying for quality, and you are definitely paying for growth.
But 37 times? That just feels rich. If I buy today, doesn't the stock have to perform perfectly for me to make any money?
Not necessarily. And here's where it gets interesting. If you look at the PEG ratio, price earnings to growth, it's actually pretty reasonable.
Can you explain PEG for the listener who might not know it?
Sure. The PEG ratio takes the PE ratio, which is 37, and it divides it by the growth rate. So if a company has a PE of 37, but it's growing at 30% a year, the PEG is roughly 1.2. A PEG under 1.5 is generally considered growth at a reasonable price.
I see.
If they were growing at 10%, a 37 PE would be insane. But because they are growing so fast, the math kind of holds up.
So you're paying for the speed. You're buying a Ferrari, so you have to pay Ferrari prices.
Exactly. That's a great way to put it.
So what's the bull case here? If I buy today at 1900, how do I actually make money?
The bull case is simple. Runway. E-commerce penetration in Latin America is only about 11%. In the US and China, it's over 20, even 30%. There is a massive amount of retail that is just going to move online in the next decade, regardless of what MELI does.
The tide is rising for everyone.
Yes. If MELI just holds its market share, it doubles in size just by the market growing. Morningstar has a fair value estimate of $2,190. That suggests there's still about 15% upside, even from these all-time highs.
But we promised a skeptical view. So what's the decision? Is this a buy?
The decision from the report is, yes, it is investable, but with very strict conditions.
Okay, what are the conditions?
It is not a bet the farm stock. You cannot put 50% of your portfolio in MELI because of the volatility we discussed, the currency, the politics. It's just too bumpy of a ride for that.
So what's the strategy then?
The strategy is a skeptical buy. You start with a moderate position, you dip your toe in, then you watch. If the price dips, which it will because LATAM is volatile, you can add more. If the new CEO proves himself in 2026, you can add more.
And what are the guardrails? When do we sell? When do we pull the ripcord and get out?
We sell if the story breaks. So if market share starts to drop, meaning Shopee is winning again, that's a huge red flag. Or if that scary credit loss number spikes uncontrollably, if we see NPLs go from 20% to 25 or 30%, you get out.
Clear guardrails.
I like that.
It's disciplined investing, not just hope.
It has to be. You can't just fall in love with the stock because it has a nice chart.
So let's recap. We've covered a lot of ground here. What are the 3 big themes we should walk away with?
Okay, theme number 1. The moat is real. It's not just a buzzword. The integration of logistics, fintech, and commerce creates a barrier that even Amazon struggles to break. It is a true structural advantage, not just a marketing slogan.
Okay, theme number 2.
Resilience is proven. This isn't a fair weather company. They have survived the dot-com crash, Amazon's entry, a global pandemic, and hyperinflation. They know how to take a punch and keep moving forward. They have that anti-fragile DNA.
And theme number 3.
The financials are durable, but risky. The high profitability covers up a lot of sins, like the high credit risk and the currency losses. It requires a stomach for volatility. You have to be willing to see the stock drop 20% on a bad headline from Brazil and not panic, because the underlying engine is still very strong.
That brings us to our final thought. We always like to leave you with something provocative to mull over.
We talked about Galperin leaving. The company has never, ever weathered a major storm without its founder as CEO. Every crisis we discussed, 2001, 2016, 2020, Marcos was there. He was the ultimate backstop.
The great man theory of business.
Exactly. The next crisis, whatever it is, will be the first true test of the institution rather than the individual. Can the culture survive the creator? Can the system run without the original architect? That is the real gamble you are taking.
That is the question. Keep questioning the numbers, keep watching the moat, and thanks for listening to The Deep Dive.
See you next time.